All right, everyone, the latest Bitcoin bear narrative is out in full swing, especially if you spend any time on Bitcoin X. There's a lot of people saying, look at the last 5-year CAGR of Bitcoin, which is the compound annual growth rate. There are a lot of coin bears looking at the 2021 cycle top, comparing the price to today, then saying the compound annual growth rate is not that good. Therefore, the institutions don't want to buy the Bitcoin. Therefore, Bitcoin's not going to get a good return. Therefore, Bitcoin goes to $10,000, etc., etc. You know what the bears say. But here is the thing. The compound annual growth rate is only a 2-point statistic. It pretends to be a life story. The formula is very clean, but that is the problem because it only knows 2 prices. It only knows the start and the end. It has zero awareness of everything that happens in between, which is like judging someone's entire marriage by comparing their wedding photo to the DMV picture that they took after a red-eye flight and a divorce. So a lot of people will look at the high in 2021 and say Bitcoin is overrated, but what they mean is I picked a start date near a mania peak in a different regime, then I'm picking an end date near a low, and then I'm gonna act like I discovered some kind of truth. We see this time and time again, so I am gonna give you some more advanced analysis, and I'm going to take the worst possible Bitcoin 5-year time frame, this exact same one that they're giving us, and I'm going to show you still why Bitcoin was an incredible investment even when I go off some cherry-picked time frame from the bears. Because here is the deeper issue. We know as Bitcoiners that it is a very cyclical, volatile asset, and cyclical, volatile assets have one feature that makes dishonest people absolutely giddy. If you pick the wrong endpoints, you can make it look like a disaster. And if you pick the right ones, obviously, you can look like a messiah. Compound annual growth rates give you a single number that can be hijacked by whoever is holding the screenshot. And it gets even more ridiculous when these Bitcoin bears are comparing the Bitcoin CAGR to other assets over the same cherry-picked window that looks bad for Bitcoin. Because at the end of the day, markets move together in something called regimes. Risk on, risk off, liquidity in, liquidity out. Everyone gets dragged around by the same macro tide, but Bitcoin moves with a bigger amplitude. So the point is, if you're picking a risk-off trough as an endpoint, congrats, you didn't prove that Bitcoin was bad, you just proved how you know how to choose an end date. So you might be asking, okay, Adam, what is the right question to ask if I am a Bitcoin investor? And let me tell you, because the question is not what is Bitcoin's CAGR from one arbitrary start point to one arbitrary end. The right question is, across all possible windows, how often does it outperform other assets? That's how grown-ups actually measure performance. We're talking distributions, probabilities, rolling windows, and win rates. If your argument collapses the moments that I slide the date forward 6 months, it wasn't an argument, it was a hostage note. So I'm just setting the ground rules here. I'm not doing astrology with a calculator today. We're not picking one window and calling it reality. We are going to look at a whole surface area of outcomes because if Bitcoin is truly a weaker asset than the S&P 500, than gold, than silver, it should lose most of the time across rolling windows. But if it wins most of the time, the CAGR bear case is what it really is. It is a coping mechanism dressed up as math. So this is what the bear is doing mechanically. They're not analyzing Bitcoin, the assets. They're selecting an endpoint that makes it look bad for Bitcoin. So what have they been doing lately? They're taking a fixed start date, usually somewhere around late 2021. You remember that cycle high. You know, the entire risk complex at that point post-COVID was in peak free money delirium, and then they're picking an end date that just so happens to be near a cyclical trough. Let's say that they pick an endpoint in the crypto winter in 2022 when everything looked like a liquidation-themed funeral. And then they say, see, Bitcoin underperformed. No, what you proved is that if you start at a high and you end at a low, the line goes down. That is not finance, that is gravity. So what I did is I took the data from the cycle top in 2021, and I'm going to keep their cherry cherry-picked endpoint just to appease them. But then I computed Bitcoin's CAGR from that start date to every single possible endpoint that exists in the dataset after it. I'm not talking one endpoint, I'm talking all of them, thousands of them. And then I'm gonna rank the bear's chosen endpoint against that entire distribution. So to show you what they do, if you take that one bear window endpoint like the crypto winter 2022, let's say a year later in 2022, that endpoint sits in the bottom 7% of all of the Bitcoin outcomes. So what is the 5-year CAGR bear case in plain English? It is, I found an endpoint that produces a bottom decile result, and I'm going to sell that as a representative experience of Bitcoin. That's like walking into a casino, taking a photo of a guy who just lost his rent money at the roulette table, and then declaring, statistically, nobody ever wins here. You didn't learn probability, you just earned cherry picking. And this matters a lot because if you can choose your endpoints, you can make any asset look good or bad. Notice how these people, when they're comparing Bitcoin to the S&P 500, they're not ending the window in March 2020 to make the S&P 500 look terrible. If you want gold to look dead, they're not ending it in 2015. If you want Bitcoin to look like a scam, just end it at the cycle low. If you want Bitcoin to look like the second coming, end it at a cycle high. Compound annual growth rate does not protect you from manipulation, it invites it. So the only intellectually honest approach is don't argue from one endpoint, argue from the distribution, look at all of them. And then on top of that, of course, it's not enough to take that 5-year CAGR number. They continue to compare them with other traditional investments that you could make, whether it's gold, silver, the S&P 500, etc. But here's the part that they don't want to say out loud. Obviously, there's something called correlation, okay? And there are things called regimes, the liquidity regimes like I just mentioned. We know that if liquidity contracts, everything gets punched in the throat, but Bitcoin just tends to get punched harder because it has higher volatility, higher reflexivity, etc. So these people are running this brilliant statistical experiment. Step 1, pick a date where the risk assets are euphoric. Number 2, pick a date where risk assets are miserable. And then number 3, announce the asset is bad. So with my data set over the last 5 years, I actually calculated the daily log return correlation in Bitcoin versus the S&P 500 was 0.415. And then Bitcoin versus something that's related, like strategy, for example, good old MSTR, that was 0.746. The translation for normal humans is that Bitcoin moves with the broader risk environment quite a lot. So when someone picks a risk-off trough endpoint like today, they're not proving that Bitcoin is uniquely flawed. They are just capturing the same risk-off unwind that hit everything. All right, now it's time to stop arguing and just drop the hammer, okay? Now remember, we are using that same cherry-pick time frame window that the bears are using against us. We could pick our own. I just want to make a point here. First, I'm going to look at every single day in the data set that I have over the past 5 years, where if we have enough history, we can compute a 2-year rolling return. That is it. No opinions, no vibes here. Same holding period, same endpoints, same math for Bitcoin, S&P 500, gold, and silver. And then I'm asking a very simple question. On a given endpoint in terms of time horizon, did Bitcoin beat the other asset over the prior 2 years? If yes, that endpoint is a win. If no, it's a loss. And then I do it across all of the valid endpoints in that 5-year time horizon. Not one, I'm talking all of them. And these are the exact win rates from the data. Bitcoin beats gold in 84% of 2-year windows. Bitcoin beats silver in 84.9% of all 2-year windows. And Bitcoin beats all 3 of them simultaneously in 82.24% of 2-year windows in that bearish 5-year time horizon. So what is that in plain English, you might ask? If you held Bitcoin for 2 years across this data set, most of the time it beat the S&P, most of the time it beat gold, most of the time it beat silver, and in more than 4 out of 5 cases, it beat all of them at once. So what exactly is the 5-year CAGR bear saying? They're saying ignore the fact that Bitcoin wins most of the time across rolling windows because I can pick one endpoint where it looks bad. That's not an investment argument, that is a coping strategy. And that's why a rolling probability chart is so devastating. It's not a return chart, it is a truthfulness chart. It shows how often Bitcoin wins when you remove the ability to cheat with endpoints. And notice something else, because I took every possible endpoint, I didn't cherry pick bull market windows. This data set includes the ugly regimes, tightening regimes, drawdowns, everything. It still wins most of the time on any particular 2-year time horizon. So if you want to look at the win rate of Bitcoin over these potential endpoints, these time horizons here over this last 5 years, there you go. The probability has dropped a bit recently because of the recent drawdown, but this just shows you that most of the time Bitcoin has been the better buy. Now I want to acknowledge the one point that the bears are half right about and then use it to bury them anyway. Yes, Bitcoin is volatile. That is not a secret. It is the entire point. High volatility means that shorter windows can look chaotic. We all know that. That's basic. So if someone insists on judging Bitcoin with a 1-year holding period, you'll see more dispersion, obviously, bigger swings, and more bad-looking endpoints. But this is what matters. I went ahead and calculated the 1-year horizon endpoints for this data set. Bitcoin still wins most of the time versus the traditional benchmarks in this bear cherry-picked data set. Now watch the Bitcoin is bad story fall apart yet again, just with more noise. The win rates across the rolling 1-year windows, Bitcoin beats the S&P 500 almost 75% of the time. Bitcoin beat gold almost 70% of the time. And Bitcoin beat silver almost 70% of the time as well. So even on a horizon where the volatility of Bitcoin is most likely to embarrass it in a particular screenshot, it still outperforms the vast majority of the time. And this is where you draw the line between the adult analysis in the room and the bear cope that you see out there. If you choose a 1-year window and then you cherry pick the worst endpoint, yeah, you might be able to dunk on Bitcoin. But when you evaluate every possible window, even in a bear-picked data set, Bitcoin beats the S&P 500 3 out of 4 times anyway. And then the real insight is what happens when you extend the horizon. As you go from those 1-year to 2-year windows, the win rate increases dramatically. That's exactly what you would expect from an asset with high volatility, but strong long-run upside. The short windows are messy, the longer windows reveal the structural trend. So if the bear wants to argue that Bitcoin is a bad investment, they are forced into one of two positions. Either they admit that Bitcoin wins most 1-year and 2-year windows in their own data set, or they can retreat back to their endpoint cherry picking, which we've already shown is bottom decile manipulation. And that's the core message here. You can complain about volatility if you want. You can't honestly claim persistent underperformance when the rolling win rates say the opposite. Now, even if one person wants to whine, yeah, but what if you bought the top? The correct answer is most people don't buy it once. They buy through time. They dollar cost average. They allocate through each paycheck. They ladder in. They behave like normal adults, not like a single candle on a chart. So I'm going to run an investor realistic test here, and I'm going to show you something quite interesting. We're going to invest $10 on every day of the bear data set. And then we're going to do that for Bitcoin, S&P 500, gold, silver, and MSTR. And this will be interesting because we're going to look at this thing first. The Bitcoin return over the past 5 years, 21.28%. Remember that, Bitcoin 21.28% over the last 5 years. And if we're going to continue to cherry pick some random date like that 5-year time period, you're going to see the S&P 500 be up 75% over the past 5 years. So 75.4% from the S&P versus the 21.2% from Bitcoin. But what happens if you DCA'd? Bitcoin beats the S&P considerably. That's correct. Bitcoin would have returned you 25.43%. The S&P 500 would have been 16.2%. Because dollar cost averaging mathematically neutralizes the obsession with one entry price. If the bear argument only works when you assume a lump sum buy at the exact wrong moment, well, it's not describing reality because people don't don't invest like that. It's describing a straw man investor that only exists in Microsoft Excel. So even when I'm using the bearish time horizon, I'm not hiding anything. I am saying that Bitcoin wasn't the top performer in their bear data set on DCA. Silver takes the crown. MSTR is number 2. It beats gold, and then Bitcoin is number 4, beats the S&P. Fine, that's reality, but the point of this slide is not that Bitcoin beat everything in every sample. The point is, even when you use the method that is fair to most people, Bitcoin still produces elite long-run returns that is not even remotely debunked by cherry-picking a CAGR number. If your conclusion changes about Bitcoin when I slide the end date 6 months, you don't have a conclusion, you have a screenshot. Bitcoin continues to be the best investment because it's the apex asset. Let's go. So I just wanted to give you some ammo against the bears for you to use, depending on how long this Bitcoin bear market lasts. My name is Adam Livingston. I am the Bitcoin Wizard. If you enjoyed this content, please hit the like button and subscribe to us at Swan, where we bring you the daily Bitcoin insight with more energy than anybody. And if you want to be positioned in Bitcoin before this dip is reversed, Swan Private is for you. Swan Private helps high net worth families and individuals be positioned in Bitcoin securely and strategically before the next rotation happens. And now might be a good time to do it when Bitcoin is oversold on the relative strength index, when it's oversold on the fear and greed index, and just about every other indicator you can look at. Visit swan.com/no second best to learn more. Have a terrific day. Do not party too hard. Class dismissed.